So today's workshop will be on interest options. This is one of SVT's educational workshops. Welcome back to those who have been to our event before. Last workshop, George ran it on intro to quant trading. So today's workshop will be a little bit more technical, but hopefully beginner friendly. And there's a worksheet you can answer questions on along the way. There's also food at the back, so feel free to take some. All right. Before we start, I want to just forge like how much everyone knows about options. So could you just raise your hand if you know what an option is or have studied options before in any way? Okay, 2 people. Sweet. So okay, I'll try to take it slow then. Also welcome to everyone online as well. The worksheet will be posted in the chat soon. Oh, it's already been posted. Okay. Okay, starting off with the definition. So an option is one of the things that traders trade. It's a financial derivative that gives the holder the right, but not the obligation to buy or sell an underlying for a specific price on or before the expiry date. So all of these things will be specified in the contract of option. So the contract will tell you if you have the right or the obligation to buy or sell. It will specify the strike and it will specify the expiry date. Okay, so a lot of jargon, but yeah, I'll break it down in the next slide. Oh, in a few slides. So firstly, let's see, why do we trade options in the first place? So by the definition, we saw that options give the holder the right, but not the obligation. So they can be used as a way to hedge one's risks, because if it's undesirable to exercise option, then you don't have to exercise it. So in that way, you're able to hedge your risks, like for example, hedging the possibility that the underlying will go up. So you don't have to, like, for example, buy when it's really high, or hedging your risks when underlying falls. So you don't have to sell when underlying is really low. So in that way, traders often use options to hedge and manage their risk. The next thing is that an option's price depends on many different variables, which traders can take a position on. So one of these variables is the volatility of the market. So if a trader has a specific opinion about the volatility, they're able to express that by trading options. Or more like retail investors might have opinions about the direction of the market, but they want to limit their losses, so they can trade options like to express an opinion, but not the same properties if those undesirable. And on that note, you only need limited initial capital investment to trade options. So if you want to express an opinion on the market, but for example, you don't have like, let's say the underlying is trading at like $100, you don't want to put $100 in, you can express your opinion by just, for example, buying an option for like $2. And then your payoff will be much less, but you can still express an opinion on the market. And the next thing is that options offer a lot of diverse strategies, because there's a lot of different characteristics and variables that go into how options are priced. And you can combine options with different strikes, different expiries, to come up with like interesting strategies and have an edge in the market. So a lot of our sponsors, for example, like Optiva, they're a primary player in the options market, and their strategies involve trading options with various strikes, various expiries, various underlyings, and they can mix them to have an edge in the market. So does anyone have any questions about this slide? Why options are traded? Yes. What's hedge? Hedging. Okay. So hedging is a way to minimize your risk by taking a position in a different asset class. So, like for example, if you have an opinion on like a Japanese index, you buy it, you might think you want to minimize your risk by, for example, selling a correlated product, like say Korea. And then in that way, if Japan goes like really down, then Korea will probably also go really down as well. But because you've got opposing positions, they'll cancel out in some way. So your risk is hedged. Should I explain the box? Yeah. Okay, so as I mentioned, an option in the contract, it will specify the underlying, the strike, the time to expiry, and whether it's a call or put option. So first of all, the underlying is the stock or index or commodity or any traded product that the option is based upon. So remember, in the definition of an option, you have the right but not obligation to buy or sell the underlying. So this is what it's based on. So you can have an option on an index, an option on a single stock, or anything, right? And then a call option is when you have the right and obligation to buy the underlying, and a put option is when you have the right and obligation to sell the underlying. Right. So two main types of options, calls and puts. Right. So call is buying and put is selling. The strike is the price at which you can do this, so the price at which you can either buy or sell, and the expiry is the date at which you can do this. So depending on the type of option, it will cover soon. It will either be you can exercise option exactly on the expiry date or any time before the expiry date. Right. So these will all be specified in the contract. The payoff is the value of the option at expiry. So, for example, if you buy a call, you have the right but not obligation to buy the underlying. So if, for example, the strike is at 100 and your underlying is at 150 at expiry, would you want to exercise this option? So you're given the right to buy the underlying for 100 and it's currently at 150. Would you do that?
Yeah.
Yes, of course. So this is the payoff. In that scenario, you've got a payoff of $50, right? So it's a difference between the strike and the underlying. So a question is, why is the payoff of an option never negative? It's always either zero or positive. Does anyone have any ideas why this might be the case? Yeah, exactly right. So he said that if the payoff were to be negative, for example, then you just wouldn't exercise option. So you only exercise if the payoff is positive. Hence, the payoff will never be negative. And then the profit or loss is the payoff of your option. But then, of course, you can't just do this for free. You have to buy the option for some price. So your profit and loss would be the payoff minus the price that you pay. Any questions so far about any of the terms or concepts? Okay. So in the definition, we had that you can exercise option on or before the expiry date. So a European option can only be exercised on the expiry date. But an American option you can exercise at any time on or before the expiry date. So for today, we'll only talk about European options because they're a little bit simpler. You just have one day they can exercise it on. And a question is, if you were given an option between an American or European option, which one would you pay more for? Yeah.
I pay more for the American because it gives me more optionality.
Yeah, exactly. So we pay more for the American one because there's more optionality, or there's more flexibility in when you can exercise it. So the American option already contains the European optionality plus more, so you pay more for it. Yeah. Okay, so now we'll look at call options. So recall that call options give the buyer the right but not obligation to buy the underlying. So if your underlying is above the strike at expiring, then you would probably want to exercise this option, and you would get this difference between the strike, between the underlying and the strike. So in the example before, the underlying is at 150 and your strike is at 100, and you would exercise this and get a payoff of $50. But if your strike was at 100 and the underlying was at 80, then you wouldn't buy for 100. You can just buy for 80. So you just wouldn't exercise option, and you have a payoff of 0. Okay. So the payoff looks like a flat line below K up here, and then it's a break at one line above K, right? And we can see here that the graph is shifted down by the price. This is because this is the graph of the profit and loss. So you get the payoff at expiry, but then you have to pay some price for the option. So your profit and loss will be whatever your payoff is minus the price. So everything is down. And then the break-even point is the price the underlying has to settle at in order for your profit and loss to be 0. So in the example where your strike was 100, and say you paid $2 for the option, what would your break-even point be? What do you want the underlying to settle at least? 102, yeah. So if it settles at 102, then you get $2 from the payoff, but you also pay $2, so you break even. Okay. And then we have terminology for these different points on the graph. If you settle at a payoff of 0, that's called out the money, and you just wouldn't exercise option. If you settle exactly at the strike price, that's called at the money, and above the strike price is in the money. So you might think that you just always exercise option when you're in the money, but you can say that you paid a price, so you only exercise if you're above the break-even point. Right, so just because you're in the money doesn't mean you should always exercise option. Make sense? Yeah.
The interest still exercise, because like you've already paid the premium, right? So like it's already like above that money. And like we like exercise with dollar. It's like it's already shifted down, right?
Oh, you're right. Yeah, my bad. Yeah, because otherwise your payoff will just be 0. Yeah, you're right.
I thought you would never exercise an option unless like there was a dividend payment or something, because it's like Theta time, you know, longer the time of expiring, the option's worth more money. So I would think that you would never exercise the option, but I don't see why I would never exercise it.
So are you talking about like American options?
Yeah, like for an American option.
Yeah, that's right. So for an American option, like usually it's just best to keep your option all the way up until expiry. Even if you have optionality to exercise it earlier, you still have more like chance that the underlying will go up. So you want to keep it for the whole time, unless there's a dividends payment. It's a bit complicated, but the strike will fall in value, and then you want to exercise option for American.
Oh, sorry, I thought you were talking about America. Yeah, exactly.
Yeah, so this is for European options, where you have to only exercise at expiry. This makes sense? Okay. So, oh yeah, so here the terminology long call means you bought a call, and this is the payoff. Now, on your worksheets, so if anyone doesn't have a worksheet, they can collect it over there. Try to draw here on this what you think the P&L of shorting a call looks like. So in this case, you're selling the call. Give you a couple of seconds to think about it.
Does anybody need a pen? Real pens?
Okay, so the answer is the exact same as before, but it's just going to be reflected along the x-axis. So the reason for this is whenever you buy a call, when you long a call, someone is on the other side shorting the call, and your payoffs or your profit and loss have to add to 0. So they'll just be negatives of each other. Right? So if you're shorting a call, you want the underlying to stay low. So long as you want the underlying to still high. Okay. Does anyone have any questions about this? Okay. So question 2, we have that underlying is currently trading at $130. You buy a call with a strike of $120 for $10. At expiry, the underlying is trading at $140. Did it land in the money, at the money, or out the money? That's in the money. Why is it in the money?
Because the strike price is 120 and anyone's much is 40.
Yeah, that's right. So in this case, the underlying went above the strike. So you would want to exercise this option. And the payoff would be, well, we'll see later, because this is above this, I mean, it's in the money. Next question is, where is the break even point? So at what price does underlying have to be at for your profit and loss to be zero? Yes, 130. Yep. How did you get 130?
You pay $10.
Yeah.
So you add that amount paid on the strike price. He's on the
Perfect. Good. So the break even point will just be 120 plus 10, so $130. And last question is, what is the payoff and P&L of the option? What was the payoff fee in this scenario? You found? Yeah, P&L is $10. What's up the payoff? So payoff is the maximum of 0 and S minus paid. P&L is just that minus the price you paid for the option. Yeah. So see, the payoff is 140 minus 120 to $20. But then you paid $10. So your P&L would be 20 minus 10. Okay. Does anyone have any questions about this example? Yeah, yeah, exactly. The payoff is just what you get by exercising option, and then the P&L takes into account the price of the payoff. Okay. Any other questions about this? Okay, so next we'll move on to put options. So it's very similar to a call, but this time you have the option to sell the underlying at expiry. So if you buy a put, you would want the underlying to go down, so then you can sell for the strike, which is higher. So for example, your strike is 100 and the underlying goes to 80, then you would want to exercise this option at 100, so you can sell for a higher price at 100 instead of selling at 80. So in this case, you are in the money if your underlying is below the strike. If your payoff would be the difference in minus. If the underlying settles above it, you will not exercise option and the payoff would just be 0. So the difference here is that for a strike, for a wall, we had S minus K, now it's K minus S. Because here you want S to be less than K. So you only exercise this, S is less than K, and this would be the limits. So similarly, in the money is when the underlying is less than the strike. So this part at the money at the strike, and out the money is when the payoff is 0, so above the strike. And same concept for the break-even point. Here your break-even point would be K minus the price. Any questions? Okay. So here we had this is when you buy a put. And now think about what the profit and loss would look like if you short a put. Any ideas on how you get into this? Hans? Yeah, that's right. So I don't know.
No.
Yeah, this is, I think. Yeah, this is. Okay. So it's just reflected from before. Any questions? Okay, we'll go through this quickly. Underlying strike is 100, we pay $23, and at expiry, the underlying is at 60. So did it settle in the money, out the money, or out the money?
In the money.
In the money, why?
Because the underlying is less than strike.
Yes, that's correct. So here you would exercise option and you got the sell for 80 instead of selling for 60. Right, so you settle it in the
So 100.
Oh, even better, so for 100. So where is the break even point? Yep,
I believe it's 100 minus 300, which would be 77.
that's right. So it would be 100 minus 23. This part of 100 shade is equal $77. And what is the payoff of your option? Yeah,
I believe it's $40.
I believe it's $40. That's right. Yeah. So how'd you get $40?
100 minus 60.
Minus 60. Right, so you saw that actually went 60. So you made payoff $40 and then P&L or you bought it for $23. So P&L 40 minus 23, so $17. Does anyone have any questions? Okay, so how are options priced? A main factor is the volatility of the options, of the underlying. So the key concept behind buying an option in many cases is that you want the underlying to move up so that it lands more in the money than what it initially was, so that your payoff is higher. So the volatility is a key input in many pricing models, and actually like the thing that traders often have an opinion on, like the trading options. So the higher the volatility, do you think the option price is worth more or less? There's more chance that it will make in the money, then it will be worth more. That's right. Yeah. And then of course all of the things outlined in the contract, the strike price, expiry date, the underlying, so where the underlying actually settles at, and then some secondary factors like interest rates, dividends, but like compared to the others, they have a minor. So you might have heard of the Black-Scholes model. A very like simple way of describing how price intrinsic is like not realistic, but we can be introductory way to how options are priced, which you might learn at it. There's like two paths to what can take, there's like up and down, like every 25. Any questions? No. Okay, so to drill in on why volatility is important, let's consider a stock that's trading at 100, and there's two paths we can take. In scenario one, there's a 50% chance we go up to $102 and a 50% chance we go to $98. And then in scenario two, the underlying is more volatile. There's a 50% chance of the up to 160 and 50% chance of going down to 50. So given these things, if 500 underlying 100 times 5 is 1 day, what? So this represents 1 day. So what would be the expected payoff of a call option under each scenario? Morris?
1 in 25.
Yeah. So how did you get $1?
One, because if it goes to 98, I just wouldn't exercise it. If it's 50% chance to gain $2, so 0.5 times 2 is 1.
Yeah.
And then the same psychology for the scenario.
Good. Yeah, perfect. So basically, if the stock is 98, you wouldn't exercise this at all because you would not want to buy or you just not exercise it, you pay for the zero. And if it goes 102, you would exercise the call and you get a payoff of $2. 50% of the time, your option will pay you $2. So your expected payoff is 50% times 2, so $1. And then in this scenario, similarly, the different numbers. In this case, because 50 is not amplified option. Okay, 0, and then here you have $50. So your expected payoff is 25. The key concept is that in scenario 2, you're going to pay $25 much more than scenario 1 because this underline is a higher volatility. So higher volatility is a higher option prices. Does anyone have any questions about this? No? Simple. Okay. So when you're trading options, you'll see the price that it's trading for, and you might want to invert the pricing model or like the price to see what the volatility had to be to input into the pricing model in order to get that price. And this is what we call the implied volatility. So it's the price, it's the volatility implied by the price of the option. So it's what you would expect your future volatility to be up until expiry, given the price of the option. Okay. So, for example, here we have an underlying that's at 100, and there's a 50% chance it will either go up or down by X%. And the option is trading at $5. So given this, given that the option price is $5, then what would be the up and down movement of the stock implied in this price? It's like working backwards from the last issue. Yeah, very quick. That's good. So 10%. The way you can arrive at this, actually, do you want to explain how you got 10%?
Half of the time it's going to go up. If it goes up, you still do.
Yeah.
So that makes you do.
So in this case, 50% of the time, exercise option, when it increases, and you get X payoff. Plus, I chose 100 plus X% of 100 is just going X. When it goes down, you wouldn't exercise option to get 0. So implied percentage is 10 in this case. To see how you can work backwards, this is a very simple model, but most models you can work backwards and get what the implied volatility is. Any questions? Yeah, so it's a percentage because you can usually talk about volatility as it's almost equivalent to the expected percentage move up and down. So a volatility of like 0.02, you just say 2%, and you're kind of expecting that the underlying will go up 2% or down 2%. Up and down 50%. Oh, so things are the probabilities. 50% of the time it will go up X. 50% of the time it will go down X%. So it's a very simplified model of how a stock can behave, where there's only two parts at up or down 50% of the time. So that's or would you like me to explain it further, like any part of it? So implied vol is, in contrast to realized volatility, which is what you actually experience in the market. So the prices might imply one volatility, but then what actually happens, that's a realized volatility, and that's what you make money. So for example, if there's more volatility in the market than what you paid for, then you're going to profit generally. If there's less realized volatility than what you paid for, what was implied by the price, then you're going to lose money. Because remember, higher volatility means higher option prices. Right? So yeah, the realized volatility is the volatility actually calculated from the underlying movements. So here we have a question. where you're assuming that volatility is mean reverting in the long run to 12%. So just a very basic assumption. And you under this assumption, what trades would you make in these two options? So you have a 2-year call with a strike of 100 that's trading at an implied volatility of 11.9%. Or you have a 1-day put with a strike of 110 that's trading at an implied volatility of 12.1%. What trades do you think you would make with these two? You don't have to trade any of them. You can trade one, you can trade both. What would you do? Yeah, sure. It doesn't matter. You're only trading in the volatility. Firstly, let's see this one. You have a 2-year call option. So 2 years is like very long. And it's trading with implied volatility of 11.9%. Would you trade this if you're expecting that volatility is going to be 12% in the long run? Who thinks yes? Okay, we have a trader that thinks yes, and he's correct. So yeah, like you have a 0.1% difference in what you expect volatility to be and what you're buying it for. So you can think of volatility as like a price, even though it's not dollars. You can just think of it, you're buying for 11.9, but it's going to be 12. So you would buy this. Right? What about the 1-day put? So it's trading above historical volatility. Would you want to trade this? Who thinks yes? No? So this? Why would you sell? Yeah. So that's true. This is above this. But remember that this is the historical volatility, and you're only going to, it will only revert in the long run. So in 1 day, like anything can happen. So just under this assumption, just knowing that in the long run it's going to be 12%, you wouldn't be very confident of what's going to happen in 1 day, right? You might want to make some more assumptions, have a better model for your realized hold than just this. So based on this, you wouldn't really want to trade this option. You wouldn't, like, if this was a 2-year option, then you would probably sell this because you're paying more than, or you will be selling for more than what you realize. Right. Yeah. Yeah. That's right. I'll figure the next day. Exactly. Yeah. Yeah. So this is a time when you exercise option. Does anyone have any questions or disagree? Like, this is pretty open question. It's not really one right answer. Does anyone have different thoughts? Happy with that? Okay. Okay, so we talked about the payoffs of the option, which is what this looks like. And then we said that we would always pay more. You would always pay more than what the payoff is, because you're paying for the possibility that your underlying will go more in the money. And this is what you call extrinsic value. So your price is composed of 2 things. First is the intrinsic value, which is just payoff. So it will be a total line. Plus the extrinsic value. So this is the extra amount on top of the intrinsic value that you'll pay. And you can describe the extrinsic value as a probability weighted payoff if it lands in the market. Right? And it depends on the volatility. So more volatility means more chance that it lands in money, and time. So more time means it's more time to experience volatility. So you would pay more for longer dated options. And the extrinsic value, looks like it's the red line, you might not really see it from blue. So you can see that here the extrinsic value is the highest at the money. So when you're at the money, that's where it's like very binary. Either you're going to land at 0 or you're going to land, like you land either out the money or you land in the money. So that's where you have the most chance of your payoff changing. It's like where the payoff changes the most, you have the highest extrinsic value at the money. Notice that the extrinsic value is actually the same for calls and puts. So when you're trading options based on volatility, it actually doesn't matter if you're trading calls or puts, they're regarded as the same thing. They both have the same extrinsic value, it's just that the payoffs are different. Right. So the extrinsic value peaks at the money and then it spreads down as you go further away. So for example, if you're very out of the money here, like your underlying is much lower than your strike, then there's not much chance that you're going to suddenly jump up and then in the money.
Yeah.
So you wouldn't be paying much more than $0 for this option. And if you're here, then there's not like the chance that you're going to move even more up. It's very unlikely. So you only pay a small amount more than the pay. Right. So the most time value is when you're out of money, which is where it's the biggest change happens. Right. Does anyone have any questions about this? Right, and then when you add up these data lines, then you get this curve, which is the price. So for a call option, if your underlying is much higher, you pay more. If it's less, you pay less. And opposite for put. And yeah, this is the price, the fair value of the option. Any questions? Okay. So, as I mentioned, the volatility is a key factor that goes into how much an option is worth because you're paying for the chance that it might move up a lot. So a question is, if you have higher volatility, like yes, the underlying might move up a lot, and you're going to, let's say for a call, it moves up a lot, and you're going to have a bigger payoff. But you can also move down a lot, right? So why would you pay more if there's higher volatility? Like you're still moving up and down, but for a call option, why would you still pay more if there's higher volatility? Yeah.
Because the downside is limited to how much you pay for the option, but there's unlimited upside potential.
Yeah, exactly right. So with volatility, when you move up, your upside, which is what you call when like it lands above, it's unlimited. So every time it moves up, you gain like $1 extra. But if you're moving down, the payoff is just 0. You don't have to exercise the option. So you have this optionality that makes the option worth more if there's more volatility. Right? Any questions about that? So here we have 3 different scenarios. Let's say low, medium, and high volatility. The low volatility option, say 5%, is this red line where the underlying is not going to be moving much. So you would almost pay exactly what the payoff is, very close to the payoff, because there's not much chance that the underlying is going to be moving, and you'll likely just end up exactly where the underlying started, and you'll get the payoff. But as you increase the goal, then you start paying more and more for the option, because there's more chance that will go up, and there's also more chance will go down, but when it goes down, it just goes through. But when it goes up, you get unlimited upside. And the same thing happens for calls and puts. So both are worth more given the volatility. Would anyone like to ask a question about this? Confused or any comments? Yes.
Why is it that both puts have the same shape? Because puts, you can only go to zero, or you go to infinity.
Right, so there will be a slight difference, actually. But it's very minor, so for simplicity, we just say they're the same. So his point was that calls have unlimited upside, but puts, when you lend in the money, the underlying cannot go below zero, so your payoff is capped at this amount, right? But it's like given a distribution of the underlying, it's very unlikely to be going further than this. So just for simplicity, you could say that this like they have the same intrinsic value, right? Yes.
The conference isn't like all the yields is supposed to intersect so I can kind of yeah. And then visual stuff. Yeah.
Oh, yeah, I think you're right. Yeah. So Implied is saying I think it will be at 10. Because your intrinsic value is 0.
Yeah. Yeah.
Yeah, I think that might be right. I'll think about it later. So yeah. So a very similar diagram, but now we have the effect of time on option prices. So often you can think of having more volatility as being the same as having more time, because with more time, there's more time to experience the volatility. So if we see the payoffs with 1 day, 5 days, or 10 days expiry, the 1 day option has very little intrinsic value, because in 1 day you're not going to expect much movement, so you likely just settle at whatever the payoff is. Right? More days to expiry, you have more time for the underlying to move, right? So yeah, you can think of more time as more volatility. Yeah, basically it's the same concept as before, right? There's more extrinsic value with more time. Any questions? Okay. Oh yeah, I forgot to mention at the start that options have increased a lot in like turnover, like the amount that's traded in the recent past. So they surpassed how much just stocks on their own have been traded, like here in 2021. So given what we've learned today, why do you think that people have been trading more options since 2021? Yeah, so it's a safeguard. So why not in 2013? Yeah, what's been causing uncertainty? Yeah, so events like COVID, like Russia, Ukraine, there's a lot of uncertainty in the world, and there's more volatility in the market, which means the underlying can go up and down like at any moment. So options are used as a way to hedge your risk. And also a secondary point is like given that there's more events happening, then traders are probably going to be more opinionated about the volatility. So they might have stronger opinions about what volatility might do in the market, and they're able to express this by trading options. But in general, like retail investors would trade options just to hedge their risk of potential downside. Make sense?
So what was the what was been traded in 2008?
Yeah, good question. So this is a financial crisis. I'm not sure. Maybe just in general, like the financial market was not as popular, so people weren't aware that options existed. Yeah. Not sure. Might have also just been a very sudden event, like COVID is prolonged period of volatility. Global financial crisis is just like a very sudden thing that just ends, right? Yeah. Okay, so the main focus of today will be on option briefs, which look at how the prices of option change as we change things such as the underlying volatility and time. So you can think of option briefs as representing the sensitivity of an options price to these things. And they all have brief names, not sure why they're brief, but for example, delta talks about the change in options value given a change in the underlying. And you can think of it as the partial derivative of options value with respect to the underlying. So we'll just use underlying for value. Gamma looks at the change in the delta given change in the underlying. So it will be the derivative of this with respect to the underlying or the second derivative. Vega looks at the change in the price given a change in the implied volatility. And theta looks at the change in the options value as time moves on. So usually a day, because day passes. So it's a partial derivative of option value with respect to time. So these are the four main Greeks we'll be covering today. There are more Greeks, like there's rows, which is essentially to interest rates. There's second order Greeks, charm. Yeah, a lot of different Greeks, but these are the main ones. Okay, so starting off with delta. So delta is just the change in the option value as the underlying moves up $1. So we'll skip this for now, go to here. So for example, a delta of 60 call. So just some terminology. When you say delta 60, it actually means that the derivative is 0.6, not 60. You just multiply by 100. We'll see why later. The delta 60 call is that as the underlying moves up $1, you would pay 60 cents more for this option. Right. And call options then have positive deltas because right, as a call, you want the underlying to go up. So as the underlying moves up, you would pay more and more for this option. And the delta tells you exactly how much more you would pay. On the other hand, a delta of 30 put would be worth 30 cents less given a $1 move in the underlying. So here, the delta of this put is actually negative 0.3. But we just assume that there's no confusion when you say a put and the delta is inherently negative, and you just say delta 30, right? So puts have payoff when the underlying moves down. So if the underlying moves up, you would pay less for the option. That's why the delta is negative. Right? And as the underlying moves up, the maximum, let's say for a call, as the underlying moves up, the maximum more you would pay for a $1 increase in the underlying is just $1, because you would never pay more than what the underlying actually moves up by. And for a put, same reasoning, the minimum it can be is -1. You would never pay more than $1 less than what then given a $1 move up in the underlying. Right, so core deltas went from -1 to 0. I'll just say -100, 0, and 0 to 1 for the 4. But I think I said the wrong way around. Negative, positive, positive. Does that make sense? So some things we can note is that actually talk about this later. Let's move on. So here is what the graph looks like for the delta. So at the top, we have the core delta. This is the strike. So as you are out the money, so down here, as the underlying moves up, then you will pay between like $0 and $0.5 more for the option. And as underlying is higher, you pay between 0.5 and $1 more. So if you're very out of the money, as the underlying moves up, it doesn't really mean anything. You're still very out of money. So your change in the options price is very close to zero. On the other hand, if you're very in the money, as the underlying moves up $1, then you probably just end up getting that $1 more. So you would pay close to $1 more for this option. Okay, and at the money, so here it's 100. It will be roughly 0.5. So as the underlying moves up and down, you pay about, as underlying moves up, you pay 50 cents, about 50 cents more for the option. And then put deltas range from -1 to 0. So here, when you're, remember, for a put, you're selling, you want the underlying to go down. So as the underlying goes down, your put delta approaches -1. So every decrease in the underlying by 1, you would start paying closer and closer to $1 more, because you can just exercise the option when it's very out of money, and you just get $1 more as underlying moves down 1. And if you're very out of the money, so the underlying is above this, right? Your payoff is 0 already. So like as the underlying moves up, you just, well, you're paying less, but the amount will be closer and closer to 0, because you're already so deep out of the money, right? You can see they're very similar. Another way to interpret deltas is the probability that you will land in the money. So, for example, for a call, if you're out here, very in the money, your delta is almost 1, because there's like 100% chance that you're going to land in the money. You're already so far in the money. And if you're at 0, then there's like almost a 0% chance that you're going to land in the money, because your underlying is so low. And at the strike price, your probability of moving in the money is about 50%. So your delta is close to 0.5. So the way you can think of this is that, like, as your, remember the slide on intrinsic and extrinsic value, and we described extrinsic value as the probability weighted payoff. So you can think of your delta as a probability. Like as you move up $1, the expected value of that $1 that you're going to get is just the probability of landing there, right? So given a $1 move, you just pay $1 times the chance of actually getting that $1, which is the delta. We pay delta more for the option. Right? So for a call, the in the money means you're landing above the strike. For a put, it's in the money is landing below the strike. So something has to happen. They have to add up to 100%, either above or below. So call deltas plus put deltas equal 100. So here we're just treating put deltas as a positive version of the number. Like -30 is actually 30. Or you can just say minus, right? Any questions about this? Okay. So, yes.
Is it strictly true that the call delta plus put delta or something? It's not a consummation side.
Well, it will be equal to, think of put call parity will be equal to E negative RT. Yeah. So if you assume interest rates are 0, this will hold true equally. If there are interest rates, there might be some differences, but we don't go into that. Okay, so we can also talk about what happens to your delta as your volatility changes. So I think the easiest way here to just think of delta as your probability of landing in the money. So let's say you have a very low volatility and you are already in the money. Your delta, like everywhere in the money, you're just about 1, right? Because your volatility is so low, the chance of just staying in the money is almost 100%. Right? And as if you're out of the money, there's almost a 0% chance that you're just suddenly going to go clear in the money, right? So as your volatility decreases, then your delta will just approach 0 here and 1 here. And you can think about the payoff diagram. The delta is like the gradient, right? So the gradient of your payoff diagram is 0 and then 1. So you're approaching 0 here and then 1 there. And then as you increase your volatility, so if you're in an environment with very high volatility, it's almost like the underlying is doing anything, and there's no difference between being in the money, out the money, or at the money, because like anything can happen, right? And remember that at the money, delta is 50. So if the volatility is very high, all of your deltas are going to be approaching 50, the same as an at the money fall, right? So this is how your delta behaves as you change the vol. It will go from this like step function into a straight line. Similar thing happens to puts because, well, you just have core delta plus put delta is 100. So you just shift it down and get the same thing. Any questions about this? So a question, just using the definition of deltas. Suppose that the underlying is trading at $130. We have a delta 64, it's worth $5, and the underlying ticks up to $132. What would be the option value now? Give you a couple of seconds to work it out. $6.20. Yeah. How did you get that?
It made up like $2 like it's like 60 cents each.
Yeah.
$1 so like $1.20 plus $5.
That's it. Yeah. Perfect. So for every $1, you gain 60 cents. So $2, you gain $1.20. So your option would be worth $6.20. Anyone have any questions about this? So next question is, we have a call and a put, both with the same strike. The call has a delta of 40. What is the delta of the put? Who said that? Oh, yeah. Yeah. How did you get 60? Yeah, exactly. So the put would just have a delta of 100 to take it to 40, so 60. So remember for the call, it's like a 40% chance the underlying will land above 120. So the delta is 40. And then for a put, there has to be a 60% chance that will land under K. So that's in the money for a put. So your delta will be 60. Okay. Well, yeah, actually, so the delta is actually negative 0.6, but we just say 60. Okay, so here we have a question about hedging. Let's say you just acquired a short position of 1,000 delta 74 options. How would you want to be delta neutral? So what trades might you want to do to cancel out this delta position that you have? Okay, so here first, yeah. So because you're short deltas, short calls, that means you have negative deltas. So in this case, you have negative $700. And if you buy a put, it also has a negative delta. Yeah, so you can short puts. So here you have a negative $700 position, which means that every time the underlying moves up, you lose $700. And then if you buy puts, puts also have negative deltas. So if you buy a put, then you're just gonna have an even more negative delta position. So what you can do is short sell the put. So it'll be negative, negative. You'll have puts would have a 40 puts would have a positive delta. So that's one thing you can do. But let's say you don't want to buy options because remember that options have different risks. Like you don't want to alter your other opinions on volatility, for example. If you just buy puts, you might, or if you short puts, you're just canceling out your position on volatility. So what can you trade that has no other characteristics? It's a very weird way to put it. That only has delta. Like there's no effect of volatility on it. The underlying, yeah. So the underlying, just by being the underlying, that has a delta of 1. So every time the underlying moves up, the underlying moves up, right? So to cancel out your deltas, you can just trade the underlying in opposite direction. So here, you have applied a negative 700 delta position. So you can buy the underlying, so 700 units of the underlying, and now every time the underlying moves up or down, you are not affected, right? So because your calls will be worth less, but your underlying will be worth more. So they'll cancel out and then delta neutral. Right? Does that make sense? So this is called delta hedging, which is one of the main uses for the delta number. It's to tell you how much of the underlying you need to trade to be delta neutral. Because yeah, usually with option trading, like for market makers, they don't want to have, well, depending on the firm, if you don't want to take a position on underlying, you want to stay delta neutral. So when underlying moves up and down, there's no effect on the portfolio. Okay. So next, have a go at graphing what call and put deltas look like as time to expiry decreases. So you can use your worksheets and maybe just draw like three graphs of like a short time to expiry, a medium time to expiry, and a long time to expiry. What you think the deltas would look like. A hint could be that you can often view time and volatility as the same thing. And we previously, I want to show you, but if you remember, there was the graph of delta versus volatility. Any ideas? So let's say you have a short time to expiry for a call. What do you think the delta will look like if you're out the money? Yeah. Yeah, very close to zero. So with a short time to expiry, if you're already out the money, you're very likely just to stay out the money. So your delta would be very close to zero. What about if you're in the money and there's not much time to expire? What do you think the delta will be? Tom? What's your
I don't know about that. But the delta would decrease.
Delta would, yeah, so your delta would decrease at some places or increase at other places. But let's say you're in the money, what will your delta approach as your time to expiry decreases?
If it's a call, or just one.
Approaches one, that's it. So it will look very similar to a step function. It will be 0 and then 1. I'll just show you. So very similar to the volatility one with low time to expiry. Your delta is approach 0 here and 1 here. Similar to puts. So in the money puts would approach -1 and out the money puts would approach 0. And with a lot of time to expiry, you can just also similarly for the volatility example, you can just think of everything behaving like an at the money option. And at the money options have 2 delta. So your by increasing small, this would approach 0.5 like this. Right? So you can see that it falls as we decrease time to expiry, your delta increases in the money, but decreases out the money. So yeah, the in the money options get closer to 1, the out the money options get closer to 0. Okay. Does anyone have any questions about this? Okay. So next, we're going to look at how the delta changes as the underlying changes, and this is what we call gamma. So gamma can be the partial derivative of delta, which is the underlying, and like we already have that delta is thinking du, so you just have the second derivative. So you can, like delta, you can view as the gradient of your option value, and gamma you can view it as the convexity. So we saw the graph that looks like this, right? So both calls and put are company up, they have positive gammas, and we can think of this. Let's say for a call, what happens to your delta as the underlying ticks up? So as the underlying ticks up, your delta would also increase because you are leaning more in the money, and there's more chance that you will stay in the money, right? So calls have positive delta, sorry, positive gamma, and then for puts, because the signs are negative, let's say you're in the money for a put, so you're below the strike price, and then your underlying ticks up, then your delta would go closer to 0, right? So because it's the other way around, you're already negative. As underlying ticks up, you become more out the money, so your delta approaches 0. It goes from negative to 0, so it's increasing. And gamma puts have positive gamma as well. So for example, let's say you have a 64 with 0.05 gamma. Then as underlying ticks up $1, then you can think of this as 0.6. You would gain 0.05 deltas. So I'm saying 0.65 and delta 65. Put delta 34 would be 0.1 gamma. So the delta is negative 0.3. As underlying ticks up, you gain 0.1 deltas. So your delta is now negative 0.2, or you can just say delta expensive. Right? So in both cases, well, in absolute terms, the put decrease, the call increase. But if you account for the negatives, it's going to be negative 30 to negative 20, so they increase. So gammas of calls and puts are the same. Yeah, I think they're just exactly the same. It's not an approximation. So, and it peaks at the money. So at the money is where the most change can happen. So your deltas would change the most, right? Because remember your payoff diagram, it's like gradient 0 and then suddenly gradient 1. So this is where your delta is changing the most, at least in the intrinsic value. So the gamma looks like this, kind of like a delta, peaks at the money, and then as you go to the wings, it decreases to 0. Because when you're very far in or out of the money, you're kind of just stuck there, and your delta is not changing. The delta is just 0 or 1, right? Does anyone have any questions about this? If not, we will go to this. So now we can think about what happens to gamma as your volatility changes. So if we go back to, let's say, your delta as volatility changes, remember, as volatility decreases, your delta is very binary. It's either 0 or 1. And imagine here at the money, your delta is changing from 0 to 1. It's like an infinite increase proportional to your changing in underlying. So your gamma here is very extreme. It jumps highest at the money. And then everywhere else, so if you're out the money here, your delta is increasing, and then your, okay, it's a very convoluted way to put it. I'll just show you the thing. Right, so you can see that with lower volatility, your at the money gamma is very high. It shoots to infinity because your delta is just going from 0 to 1. It's like infinite gradient set function. And then for everywhere in the money, there's a higher change in your delta. So your delta is always increasing. Oh, sorry, your gamma is decreasing as you decrease volatility. Okay. So then it's an interesting thing where if you're at the wings, your delta changes less as you decrease volatility. So can anyone think of why? Why would your gamma decrease with decreased volatility? It's more. Yeah, so the slope was, we saw it just becomes like 0, right? So the slope just tends to 0. So your gamma is decreasing to 0. It's okay if this is a little bit confusing, but it's something like months to understand. So don't worry if it's confusing. Okay, so let's see an example. Let's say you have an at-the-money call, delta 50, and your gamma is 0.005, and the underlying ticks down by 2. What would be the new delta of the call option? Patrick. 49, yes. How did you get 49? Yes. So, yeah, exactly. So Patrick just did 50, take away 0.5, take away 2 times 0.005, you get 0.49. And the new delta would be 49. And a little bit of a trick question. Did the gamma of the option increase or decrease or stay the same? So after the underlying tick down, what do you think happened to your gamma? Tom. So we had an at the money call, gamma 0.005.
Yeah.
Underlying ticks down.
Yeah.
What do you think happens to the gamma?
Gamma.
Yeah. Doesn't change. Why? So if you look at this graph, you see that the gamma peaks at the money. So what would happen if it's underlying ticks down? Gamma decrease. Good job. So gamma decreases because this hole just had the greatest gamma of all of the chords with different stripes. So when you tick down, you're no longer at the money. So the gamma is reduced. Any questions? Okay, now you can think about what happens to the gamma of an at the money option as the time to expiry decreases. Remember, you can think of time and volatility as the same thing, so like the same thing. So you can think of decreasing time to expiry as similar to decreasing vol. So what happens if you decrease volatility? What happens to your gamma? George?
So when it's very close to expiring, the delta is like 0, 1, right? Is that money? So that money gamma is growing. Gamma becomes very high.
Yeah, perfect explanation. So the gamma would increase as your time to expiry decreases. And similar to the volatility graph where it just spikes up, right? It will do the same thing. So here we see time to expiry in days, it just shoots off. And if you just bring this closer to 0, it will just be like it will be undefined here. Okay. Any questions about delta or gamma? So these are the two Greeks that have to do with the underlying. So next we'll look at how the option price changes with volatility, which is what we call Vega. So Vega is a change in options value as the implied volatility moves up. Right. So for example, if you have a 0.05 Vega price at $20 and the implied volatility is 21, then if the implied volatility increases to 22%, so moved up 1, the Vega is telling you that the options price should be worth 5 cents more. So the price theoretically increases to $20.05. Okay. And before we discussed how higher volatility means higher option prices, so this means that the Vega of calls and puts is always positive, right? And this is the graph. So Vega is always positive for calls and puts. It is the same for calls and puts. So for both, higher vol means higher prices, and it peaks at the money, right? So it's similar to the gamma graph. It peaks at the money because at the money is where volatility has the biggest impact, because higher volatility environment means that there's more chance of your payoffs changing from 0 to 1, right? So this is where your price is most sensitive to volatility, and it's kind of symmetric everywhere else. So it drops to 0 as it goes in and out of the market. And we can express it as partial derivative of the value of the price with respect to the implied volatility. We could denote by sigma. Anyone have any questions about Vega? Okay. So now what happens to the Vega of an option as the volatility changes? So have a think about this. If you change your volatility, what happens to the Vega? Any ideas?
You can only read by this. What happens?
So let's say volatility increases. Do you think the Vega should increase or decrease? Oh, okay. This is tricky. So, one way you can think about this is that as you increase volatility, options behave more and more like they're at the money because there's not much distinction between being in the money, out the money, or at the money. And recall that at the money calls have the highest Vega. So if you increase volatility, then these parts are going to become more like this. So, as increased volatility, this part and that part becomes more like at the money. So the Vega will increase. Okay. So you can see here that as you increase the volatility, the Vega graph shifts up everywhere, except for at the money, your Vega actually stays the same. So your Vega at the money is not dependent on what the volatility is. Right? So a little bit, but it will stay approximately the same. Right. Any questions? Yeah.
Why does it stay the same?
Good question. So why does at the money Vega stay the same when volatility changes? Any ideas? Yeah. Yeah. So when you have the money, it's kind of like 50% chance of going up and 50% chance of going down. And now let's say you increase your volatility. Let's say you double your volatility. When it goes, let's say for a call, if you go down, 50% of the time your payoff is just 0. When it goes up, your payoff would be like double the amount because your volatility is double, right? So as you double your volatility, your expected payoff would be double just because of the in the money part, right? So the price of your option is just linear with your volatility. So the Vega is constant at the money, right? So you can think of like your at the money option prices are linear with implied volatility. So this statement is not like 100% true. There's assumptions going on, but like more or less your at the money Vega would stay constant. Does anyone have any questions about this? Okay. So next, let's think about what happens to the Vega of an option if time to expiry decreases. So remember, like before time to expiry can be very similar to volatility. So let's say your time to expiry decreases. What do you think? And that's kind of like volatility decreasing. What do you think can happen to Vega? Yes.
I think there will be less time for the volatility to act on the option.
Yeah.
Which means they should decrease.
Yeah, that's it. So your Vega will decrease if your time to expiry decreases, because as you change your volatility, if there's less time to expiry, then there's less time to experience this volatility. So your option price is less sensitive to the volatility with less time. So your Vega should decrease. Right? So everywhere your Vega decreases as your time to expiry decreases. So like up until now, we've just been treating time and volatility as the same thing, but we can see that there's slight differences. Like this graph is Vega versus volatility. This graph is Vega versus time. So usually you can just interchange between them, but there's some subtle differences like this where they don't both follow the same rules, right? Does anyone want to have a go at guessing why that might be the case? I think it's just one thing that if you know it, like kind of have to be thought why. So when you have volatility and time, your volatility up until the time to expiry is like your volatility times the square root of time. So they vary like quadratically or by square root. So you can't always interchange it. If you like double your time to expiry, for example, it's really making like a root to impact on the volatility of you're experiencing. So it's not exactly the same thing. Okay, the last group we'll look at is the theta. So basically with options, your extrinsic value comes from the money you can make if your option moves in and out of the money. So like the gamma of an option was positive. So you're kind of paying for the chance that it's going to move up and down. And then you can't just be like, receiving money all the time. You have to pay for this optionality kind of, and the amount you're paying is the theta. So as you hold your option to expiry, your so I should define what theta is. Theta is the change in option value as time passes. So by holding option, you have to be paying theta in order to be receiving all the benefits we discussed, like gamma, right? So like with options, if you're positive gamma, will be usually negative theta. If you're negative gamma, it'll be positive theta. So it's kind of like the time values that you're paying for. So the theta of an option is, so let's say 1 day passes, then you're going to pay theta less for the option for both calls and puts, right? Because with less time, your option is worth less, because there's less time to experience the volatility, right? So the theta of calls and puts are both negative. They'll both, the price will decrease as you approach expiry. So usually this is just like given, like you know that calls and puts have negative theta, so we just say the absolute value. So theta, a call would have a theta of like 0.3, but that's actually negative 0.3, right? So here we have the graph of theta. So this is the absolute value of theta, should be negative. And you can see that the amount you're paying as each day passes is going to be the most for at the money calls. Because when you're at the money, there's the most that can happen. And then as the day passes, there's like less of this opportunity for things to happen in and out of the money. Right? So the theta and gamma graphs are closely related. They follow the same shape. So it peaks at the money. You're paying the most theta at the money, and then you're paying less theta at the wings. Because if you're already in and out of the money, it's like you don't need to be paying theta, like you'll just start there. So you can express theta as the derivative of option value with respect to time. Yeah, does anyone have any questions? Yeah.
What's the scenario where you receive data?
Where you would see theta.
Receive, like when you have output data.
Right. So if you buy a call for example, then you have negative theta, right? Because you're paying for time value. But then if you sell a call, everything is opposite. So you have positive theta, you'll be receiving time value. Okay. But then if you sell a call, you have negative gamma, but you're receiving theta. So it's like you can't like really win on both fronts. You have to be paying and receiving gamma and theta. Right? Any other questions? Okay. So we just discussed how gamma and theta usually come in opposites. So suppose that the gamma of an option increases, what do you expect to happen to the theta? Any ideas? Patrick? Decrease? Increase, yeah. So your theta would become more negative to your, it would increase in absolute value because if gamma increase, your theta would decrease, become more negative. So in absolute value, your theta would increase. Is that clear? Okay, so again, one of these, how does theta change as your volatility changes? See. So as your theta increases, oh yeah, sorry, I was reading Vega. So as your theta increases, as your volatility increases, your theta will also increase because like as volatility increases, your gamma is higher. There's more change in the underlying. So your theta would have to increase as well. Right, so you have to be paying more to experience the movements in the underlying. So as your volatility decreases, your theta decreases everywhere. You become less sensitive to time if you have less volatility because with lower volatility, like the time to expiry doesn't have as much of an impact because the volatility is already low. But if you're in a high volatility environment, then you're going to be very sensitive to just like 1 day or 2 days because in those few days, a lot can happen, right? Any questions about this? Yeah. Yeah. So like for options, you have positive gamma because you want the underlying to move, right? But then as time passes, then your options price becomes closer to the payoff. So the extrinsic value is dropping to zero everywhere. So your theta would be, you have to be paying theta to be receiving gamma. And the idea about receiving gamma, like you don't just like receive what the gamma is like in dollars. So you can deploy strategies in order to like how to make riskless profit with the gamma increasing, gamma hedging. So in order to be able to do that, you pay for the theta, and they should cancel out. Yeah. Now let's look at how theta changes as the time to expiry changes. Oh, last question. So let's say that the time to expiry decreases. You think theta will increase or decrease? Increase? Yeah, why? Yeah, exactly. So if you have like 2 days to expiry. So what he said was, as time to expiry decreases, your theta increases. So the impact of a day passing is bigger the less time there is to expiry. So 1 day passing would make a bigger impact on option price, or at least at the money, as time expiry decreases, 1 day would make a bigger impact on option price. So it's like you can view the extrinsic value as kind of like dropping a lot at the money the closer you are to expiry, right? But then at the wings, your here, as time expiry decreases, your theta will increase slightly. Anyone know why? Oh, time to expiry decreases. Yeah, your theta will decrease. So same direction. If you remember, this looks very similar to the gamma graph as time to expiry changes. So we saw also for gamma that as time to expiry increases, the gamma shoots up, but at the wings, your gamma will decrease because your delta is not changing much on the wings. So the opposite happens to theta. If the gamma is increasing, then you're going to be paying more theta. So the effect is the opposite at the wings. So you can think of, let's say you have 5 days expiry versus 1 day expiry, and you're in the money for a call. Then with 5 days expiry, you're kind of already stuck in the money, but there's like more impact of 1 day than if you just have 1 day expiry and nothing's really going to happen anyways. So as your time to expiry increases, then the theta will increase at the wings. Does anyone have any questions about that? Yeah, sweet. So we'll just wrap up with a summary of the risk profile of calls and puts. So we saw the delta of a call is between 0 and 1. For a put, it's between -1 and 0. So this is the change in the price with respect to the underlying. The gamma is a change in the delta with respect to the underlying. So calls and puts both have positive gamma. The Vega is the change in the option price with respect to the volatility. So the more volatility you have, the more you would pay for both calls and puts. The calls and puts both have positive gamma. And to be receiving all this, you have to be paying theta. So the calls and puts both have negative theta. Right. So you can see that the risk profile of calls and puts are almost identical, except for the delta. But we saw that if you buy an option, you can just hedge your delta anyways, so you don't really care about your delta. So like buying calls or puts is kind of the same thing as when you're trading options. It doesn't matter. The risks are identical if you're hedged. Okay. Any questions? Well, that wraps up the workshop. We can have, oh. Yeah. So you can connect with us on these different social media platforms. Yeah, Instagram, Facebook, LinkedIn, Discord. So Discord fortnightly we have mock trading. And our website. You can see our sponsors on the website. So thank you very much to the sponsors and everyone for coming.